I've got the great privilege of standing here with Zachariah George, the managing partner of Launch Africa Ventures, who is one of the most active VCs here across Africa. Zach, welcome. Thank you for being with us here today. Mind telling us a little bit about yourself and the fund?
Thanks, Ant. It's a pleasure to be here. We are the two co-managing partners of Launch Africa, myself and Junaid. We built Launch Africa about 3 years ago. We're now the most active, prominent early stage, so pre-seed and seed stage focused fund across Africa. We've invested in more than 130 companies across 22 different African countries, and we're just about to launch our second fund to continue the work we did in Fund 1.
Fantastic. That is a huge reach across the African continent, but your journey didn't start here investing in Africa. So can you tell us a little bit about your story and the genesis of what led to Launch Africa?
It's quite the complicated and unconventional story. I used to be a Wall Street investment banker at Lehman Brothers and Barclays in New York City in the early 2000s, and was a bit disillusioned by the lack of any clear, significant impact of the work that I was doing. I came to South Africa on a holiday for the World Cup in 2010 and realized that there was a huge amount of similarity between what India was seeing at the time in its venture ecosystem and what Southeast Asia was slowly nipping away from an e-commerce marketplace standpoint. And I said, Africa has, at the time, more than 1 billion people, growing very quickly from a reduction in cost of data, smartphone penetration, and I said Africa is the next India, Africa is the next Southeast Asia. So a few years later, I set up an accelerator called Tech Lab Africa, which became Techstars. It was run by Barclays, and then eventually I brought Startup Bootcamp to Africa. Startup Bootcamp was one of the largest accelerators in Europe, and it was the first time that corporate Africa, which is to a large extent dominated by telcos, banks, insurers, and retailers, understood that in order to be innovative and ahead of the game, they would have to work with startups and not ignore them, and not commercially not work with them. So we set up the first Africa chapter of Startup Bootcamp. We had initially a whole bunch of fintechs from across the continent that joined the program, and the intention was to do POCs, proof of concepts, and pilots with large banks, insurers, and telcos. And we very quickly realized that a lot of these fintechs, insurtechs, and e-commerce startups and marketplaces were batting way below where they should be not because they lacked product market fit, they just didn't have access to distribution. So partnering with the large retailers, the banks, the telcos, allowed and solved for that distribution. It then got early stage investors, angels, friends, and family, and syndicates involved. And that was a catalyst to me to say, okay, if we've solved the acceleration and incubation problem, the next step is, how do you bring institutional capital and institutional prowess at the early stage pre-Series A? And that was the birth of Launch Africa. So Launch Africa essentially was a post-accelerator pre-Series A fund, initially focusing on the big 4 markets of South Africa, Nigeria, Kenya, and Egypt. But we very quickly realized that you can't ignore the rest of the continent, and we've now got a presence in 22 different countries.
Fantastic. And I hear you were saying that we talk about accelerators in the market is often the first indication to a startup ecosystem starting to be built and flourished. Corporates coming in, the proof of concepts, showing that these companies can scale, can serve larger markets, and eventually see exits. But within your fund, you're coming at that early stage, the most risky side of things, but also you're in nearly half of the continent's countries outside of the big 4 that you just mentioned. So what is the conviction drive to be looking at those markets? Because if I'm an investor in Europe right now, I'm going to be hearing reports on South Africa, Nigeria, Kenya, and Egypt, and rightly so because of the work they're doing. But what has you starting to become deeply entrenched in all these other markets that we're not seeing as headlines on all the reports?
Yeah, absolutely. I think you got to go back to the basics, right? How do you use technology to solve real world problems? Irrespective of how rich or how poor you are, you still need food, water to get from A to B, transport, logistics. You need to be able to get educated. You need to be able to access drugs, healthcare. So if you look at the most basic consumer staple industries, right? Financial services, education, healthcare, mobility, energy, right? All that we're doing is finding technologically relevant solutions to an industry that has predominantly been brick and mortar for the last 20 years in Africa. That's all we're doing. But it's channeling money away from what would typically be very expensive debt that would go to industries like agriculture, manufacturing, mining, oil and gas, and power. And it's now investing in businesses that serve those industries. So an example I often give is instead of building another school or building another college or building another hospital, let's invest money in technology that can do remote medicine, that can do telemedicine, that can do online booking appointments. Instead of building more fleets of taxis, let's invest in cashless payment opportunities for the informal sector. So you're just supplying the same industries but doing it through platforms. And platforms by definition have to be tech-enabled. And you will never find a bank or a traditional lender fund platforms because platforms have no assets, therefore no collateral. But VCs understand the value of intangible assets. So the other thing about Africa is distribution in Africa is controlled by the insurers, the telcos, and the banks. Therefore, the majority of businesses that we invest in are B2B or B2B2C. So markets outside of the big four, like a DRC, the Republic of Congo, Ethiopia, Senegal, Cote d'Ivoire, as long as these countries have large populations that are growing quickly, have relatively stable government structures, have strong corporate alliances and penetration, so you need to have one or two dominant telcos, banks, or retailers, because that solves for distribution, has a low cost of data. Why is that important? Because ultimately it's consumers that are creating value for enterprises. So you got to have a low cost of data as in mobile data, so purchasing power increases, and you got to have a high penetration of smartphones. So that perfect storm of mobile penetration, low cost of data, and a growing youth involvement in the digital economy, those are criteria that we apply. And there are a lot more than just the big four that make sense. And hence the reason why we've now done deals in markets like Cameroon, Senegal, Cote d'Ivoire, Morocco, Tunisia. Africa also has the advantage over Europe, this is important, that even though we are 54 countries and we speak hundreds of languages, the language of business is only English, French, or Arabic. And we only have 3 common laws: English law, French law, and Sharia law. So it is easier for a startup in Ghana to expand into Nigeria than a startup in Germany to expand into the Netherlands, because you've got different banking systems, different common law systems, different languages. So it's just a question of understanding how can we work with the cultural and legal simplicities in Africa, but understand how we can apply developed market attitudes towards risk for the African continent.
Fantastic. And speaking there then of that kind of those European ties and relationships, or that comparison between the continents, as a VC fund manager, you're not just mobilizing and deploying capital, but you're telling the stories of the continent. You're
Correct.
paving the way, you're building the market for others to operate in. So if I'm a VC or I'm an LP in a fund and I'm looking from Europe into Africa, what role do you guys play for those investors on the outside looking in, and how are you helping them to enter African markets?
Yeah, it's very hard for LPs or angel investors in Europe, Asia, or the US to do deal-by-deal investments in Africa unless you've got a personal relationship with the founders or the founding team. Right? Angel investing, which is why angel investing typically worldwide has been you invest in what you know and where you know and who you know. One of the ways to circumvent that and take advantage of opportunities in emerging markets like Sub-Saharan Africa, like Southeast Asia, like Latin America, is to invest as an LP in funds that have boots on the ground and very strategic relationships with accelerators, incubators, angel groups, co-working spaces. So they do the vast majority of diligence, and diligence is financial, technical, operational, and human, right? The accelerators are a great feeder for the funds. What LPs should then hold the GPs of funds accountable for is, if I, as a potential LP, invest in your fund, can you give me privileged access to individual deals where I can invest alongside you, often called co-investment rights. One of the things that we are very proud of is we allow all our LPs across Fund 1 and Fund 2 to co-invest alongside us. We do all the heavy lifting, the DD, all the founder engagements. We even help structure term sheets. LPs literally invest alongside us. We don't charge them any fees or any carry. No creation of SPVs and other contracts. It's very simple. And then they get to invest directly in companies. So it's an approach where you put your foot in the water, get a stake in a fund that has 50 plus companies, in our case 100 plus companies, and then leverage those co-investment rights to double down directly. And you will often get more return and upside on the co-investments than you will on the fund investments. Because fund investments obviously have a power law that sort of averages returns for a fund, which you don't necessarily have in direct investments.
Fantastic. So if we're using venture funds like yourselves, these entry vehicles, we also have to look at where the challenges are for these international investors. Now, over the last year, global downturn in investing at all asset classes, but one of the things we've seen a lot of companies on the continent go bust in various shapes or forms, some of them just running out of capital, but others, at best, bad governance, at worst, illicit legal activities by the founders. And these are the ones that get into the headlines, into the tech crowds of the world. So what is your response to those when investors haven't even dipped their toe in yet, and because they see those things, they're like, we're going to stay on the sideline a little longer? What's your take on that?
I think, unfortunately, we suffer from confirmation bias. And I mean, there are tons of founders in Europe, in Asia, and the US that have unfortunately done fraudulent things and have mismanaged funds and go under. But because of the sheer volume of startups in the US, in Europe, and Asia, a few hundred bad apples every year is a blip on the radar. Because the size of the venture ecosystem in Africa is that small, is that much smaller, a few, half a dozen or a dozen cases of mismanagement or fraud get amplified. And the media tends to take a negative story and leverage it a lot more because it sells more copies or has more eyeballs, right? Now, I have no problem with a founder or a company going under because of a lack of runway, working capital, or just not finding product market fit. That is part of what venture capital is. That's why it's called the 80-20 or power law rule. What I do have a problem is when there is an intent to deceive and cause deceit. That needs to be, and there needs to be a black book that is shared commonly with the investing ecosystem, with ecosystem builders, that bad actors are called out, right? But if you take out the bad actors and fraud, which I would say accounts for less than a couple of percentage points in the African VC tech ecosystem, the pure opportunity for returns because of the big discount at early stage valuations far outweighs the occasional bad actors. Our fund specifically, we believe that investing very early at the seed stage, post-accelerator, so you post-product and post-revenue, you can get into companies at valuations of between $2 and $5 million pre-money. And there is a lot of international and continental interest in companies once they've crossed the $1 million in annual recurring revenue threshold. So we typically arrange most of our exits through secondaries, which is a very important point for investors overseas to understand. Africa is actually one of the most active venture ecosystems in the world. What you don't hear in the news is how these exits happen. So for a continent that had just over 600 deals last year and another 1,000 the year before, we've had more than 100 exits. But most of those exits are corporate M&A. So it's large institutions like Naspers, Old Mutual, MTN, buying startups, either because of client acquisition, out of FOMO, out of product geographic expansion. The multiples on these acquisition values typically are not disclosed, right? So there's a lot of corporate M&A, but the sign of a good maturing ecosystem is when you have horizontal M&A, which is larger fintechs buying smaller fintechs, larger e-commerce marketplaces buying smaller e-commerce marketplaces. Those acquisitions typically have higher multiples of revenue than corporate M&A ever has, but they're too far and few between. But what we're seeing is a maturity in Africa now where there's a lot more M&A. The IPO market is dead, not just globally, but in Africa as well. But the opportunity to create liquidity through trade sales and secondaries is very much alive. And it's funds like us that are helping create that sausage factory of deals that can generate returns for LPs.
Fantastic insight. And so, yes, we're seeing some bad apples, some failing companies in the headlines, and we definitely need to work on governance and a unified best practice that people align to. But equally, we've got exit stories in different forms to what you may be seeing in other markets, but are getting exits on the board that need to have more attention to truly tell that narrative. Fantastic. We've got local investors, founders, operators, but just importantly, we've got international investors, founders and operators from Europe coming to collect together. What is important about today's like this, and why would you encourage more investors and other operators to be coming here on the ground on the continent?
Thanks, Dan. That's a great question. I think, first of all, kudos to the organizers, to Carlsquare, to Counder, in bringing a very select, intellectually curious group of investors, mostly from Europe, to South Africa. I think events like these are very important to just raise awareness as to what is possible. Unfortunately, there's still a gross lack of understanding as to the levels of innovation happening in Africa, because stories of African innovation and success are not typically shared in Western media. You don't see stories of innovation in Rwanda, in Senegal, in South Africa, in things like peer-to-peer payments or insurtech solutions or solutions in logistics and transportation, drone technology, sensors. These stories don't make the covers of Bloomberg or the Financial Times or the Wall Street Journal because it's just not sexy or glamorous enough. Stories about civil war and conflict and corruption sell more copies, get more eyeballs and get more clicks. So events like these, where individuals, investors, corporates get to meet the founders in the flesh and hear their stories directly, give a much more realistic picture of what is actually happening on the ground. And the reality is early investors in Africa in tech have made significantly more returns than they would if they'd invested just in Europe or the US. But you have to be smart enough to come in early and build trust networks. We heard one of the speakers today talk about the importance of trust. So events like these are very important in just taking away the fear element of investing in Africa. Secondly, investing in not just African tech, but tech in general, goes beyond just your capital. If you can't give your intellectual property, your time, your networks, your resources, then the value you add as an investor is limited to just money. So I would strongly encourage folks that want to come on holiday to Africa, go beyond just the safari, go beyond just the wine tour, and look at investing your time, your skills, your in-kind, and some of your capital to help grow these companies. There is a very strong track record of actual capital returns through secondaries, through trade sales, and be patient. The example I always give is no one believed in India 12 years ago, and India today has 120 unicorns in just over a decade. Africa has just started its journey in the last 4 years, and it requires a bit of patient capital and trust. And events like this help reduce that friction.
Fantastically summarized. And final point, launch Africa, next 12, 24 months, what can we look out for?
Yeah, so our Fund 1 has done exceptionally well. We're sitting at almost a 50% IRR, mark to market. We just launched our second fund in December 2023. We did a first close and we've backed 10 companies across multiple sectors and stages. We're now about to do our second close. Our fund's going to be open for the next 12 months at least. We're targeting a $75 million fund. We're looking for smart, strategic investors who can invest as little as $100,000 over the fund life. And yeah, we're a US dollar fund in Mauritius. And yeah, we're looking forward to smart capital to help scale the next generation of African innovators.